So in this topic, we are going to discuss capital budgeting decision and the payback period. So in this capital budgeting, we are going to discuss long-term investment decision. Under the long-term investment decision, the investment decision of a firm are generally known as a capital budget or capital expenditure decision. Capital budgeting decision may be defined as the firm decision to invest its funds in the long-term asset in anticipating of an expected flow of benefits over a number of years. It involves a current outlay or series of outlay of cash reserves in return for an anticipated flow of future returns. Next, features. First one, exchange of current funds for future benefits. Funds are invested in the long-term asset. Funds benefited will occur over a series of years. There is a relatively high degree of risk. This is relatively long-term between the initial outlay and the anticipated return. Next one, importance of capital budgeting decision. First point, capital budgeting decisions are important because of the following reason. First one, they influence the growth of the firm, substantial expenditures, long-term periods. Under the long-term periods, the effects of the decision will be felt over a long period of time. They have long-term consequences influencing the rate and growth of the firm, high risk, irreversibility, complexity. Next one, types of investment decision. Different ways to classify investment decision. First one, expansion, diversification, replacement and modernization, research and development. Another classification, mutually exclusive investment, independent investment, contingent of dependent investment. Next, capital budgeting process. First one, identification of investment proposal, screening the proposal, estimation of cash flow, evaluation of proposal, fixing priorities, final approval and preparation of capital expenditure budget, implementing proposal, performance review. Next one, methods of capital budgeting. First one, traditional methods. Under traditional methods, time-adjusted methods or discounted methods. First, what is a traditional methods? Under the payback period method, rate of return method, time-adjusted methods or discounted methods, net present value method, that is NPV, internal rate of return methods, that is IRR, profitability index method, that is a PIM. Now, payback period method. The number of years experience to recover the original cash outlays invested in a project. Payback period equal to initial investment divided by constant annual cash inflow. In case of unequal cash inflow, payback period is found out by cumulating cash inflow until the cash inflow equal the initial cash outlay. Acceptable rule under the payback period. The shorter the payback period, the more desirable in this project. Firms generally specify the maximum acceptable payback period. Advantages. Simple to understand and easy to calculate. Cost less than other method. It is a rough and ready method to dealing with the risk. It reduces the risk of loss through the possible obsolescence. Suitable for firms having shortage of cash or liquidity problem. Limitations. It fails to consider the time value of money. It ignores the cash flow beyond the payback. Does not consider the cost of capital, which is an important factor in making sound investment decision. Determining a minimum acceptable payback period is a subjective decision. It is a measure of the project capital recovery, not profitable. Popularity of payback period. Popular because of the following reason: simplicity. A company can have more favorable short-run effects, EPS, that's earning per share, by accepting the project with short-term back period. The riskiness of the project can be tackled by having a short payback period. The emphasis in payback is an yearly recovery of investment, thereby giving an insight into the liquidity of the project. We can discuss the next class related to this topic. Thank you.